Fundamentals of financial statements. Starting a business requires much time, commitment, and patience. The ultimate goal of most businesses is to be professionally and financially successful. In order to show the progress of business operations, meticulous financial statements must be kept. This statement communicates economic information about the business to individuals involved in making decisions and judgment. According to the University of Phoenix, 2006, an entity's financial statements are the end product of a process that starts with transactions between the entity and other organizations and individuals. This simulation, Connie started a cookie business in 2017. Developed was a business plan and placed people to assist. Connie was concerned she needed someone to maintain the financial accounts. Her business, Aunt Connie's Cookies, financial statement for November and December are reviewed along with a suggestion to expand our operation. The transaction in Connie's financial statements address the balance sheet, income statement, and statement cash flows. Reviewed will be a few transactions in the business sheet and income statement. Connie's initial transaction of depositing $80,000 into her account to start her business increased her property. This transaction increased the company's equity and was added to the balance account. The balance sheet is sometimes called the Statements of Financial Position because it summarizes the entity's resources, assets, obligations, liabilities, the owner's claims, owner's equity. Kitchen and office equipment were purchased along with the supplies. With these three transactions, she increased her property. Purchasing the supplies increased her debt, but still added value to the operation of the business. Meeting her obligation of the first sale increased revenue. This is shown in the income statement. This statement will show Connie whether the business is operating at a profit or a loss. Greta, in 1998, stated the following: "The balance sheet can show how financially sound a company is. The income statement can answer every investor's central question: how much money are they making?" Even more important, the income statement can provide a solid basis for forecasting future profits. If Aunt Connie was seeking a loan to expand her business, the financial statement can show income in advance. Aunt Connie can, in good faith, accept a future order from a client. Connie can show this transaction as income received in advance and a liability under unearned revenue. During the process of balancing the books for the income received in advance will be entered as an adjustment. However, one bank is probably less likely to lend Connie the money. Connie may need to seek several sources. The business has been in existence since November and does not give a good overview of the profits and or losses. A small profit is shown during that time. Hendricks, 2005, provides the following for entrepreneurs after 1 year of business startup. Personal savings, friends and family, and bootstrapping suffice to start many a new enterprise. But as your company grows, needs for capital are likely to outstrip those initial funding sources. The good news is that now you have a track record. You'll be much more attracted to banks, angel investors, and other financial sources. Connie needs a stronger and longer track record of her business performance to strongly negotiate borrowing money. After reviewing the simulation of Aunt Connie's Cookies from November and December, the following was discovered. Initial startup of $80,000, increased equity and property. 2. Purchase of kitchen and office equipment, increased property. 3. Office equipment, increased property, purchase on credit and shown as a debt in accounts payable. 4. She partially settled her debt with cash and decreased her accounts payable. 5. Rent paid in advance, increased property and decreased cash. 6. From her first sale, revenue increased. 7. The credit sale increased accounts receivable and revenue. 8. The credit sale paid in cash, which decreased her accounts payable. 9. Salaries paid decreased expense in capital. 10. Utilities in the expense decreasing cash. 11. Personal use of cash decreased cash and capital. 12. Insurance decreased by $6,000. Expenses decreased by $500 to cover the premium for the remaining of the year, which the remaining was placed in the unexpired insurance for the next year. 13. An order not year received increased cash and unearned income. 14. Money borrowed has interest. It is a liability as accrued interest and analyze interest expense. Financial statements are extremely important in a business. The statement gives a snapshot of the profit or loss either quarterly or yearly. Included are the gross and net sales, operating expense, and profit, pre-tax profits, taxes payable, net income after taxes. Income statements are valuable tools in situations where credit review may be necessary. Making a side-by-side comparison of a company's income statement and balance sheet over 2 or more accounting periods makes determining trends and spotting emerging problems far easier than looking at a customer's financial performance during a single accounting period.